Hello, hello, Pankaj ji.
Hi there.
Hi, Pankaj ji. Shall we start?
Yeah, we can, sure.
So, good evening, everyone. First of all, I would like to welcome CA Pankaj Jain ji, Director EVA India. Uh, right now, we are live on YouTube and Facebook, uh, and we have more than 3,000 viewers on Facebook and YouTube right now. Uh, due to tax deadlines approaching, I think there is a lot of pressure on professionals. So let us start today's session. First of all, going forward, very few people know when I was in EY, uh, and when finally I decided to start my practice with my dad. uh, we started GST Samadhan, and in 2017, around May 2017, uh, I and my friend Navya invited Pankaj sir on our first seminar. That was our first seminar of our life, and uh, he was very humble in inviting our seminar as a guest speaker over there. And after 3 years now, we are again having him here. So I welcome you again, sir. Now, CA Shivangi Agarwal, our core member, will take the session forward. Over to you, Shivangi.
Thank you, Aditya. Am I audible enough?
Yeah,
Okay.
yes.
Hello, everyone. Professional Times aims to keep its viewers, abreast and updated with all the latest developments, amendments, and various news that are happening in the financial and accounting and taxation matters. So, Professional Times have started with this foreign trade policy series wherein renowned speakers would come up and would enlighten us and imbibe us with all the latest knowledge that are happening uh, with respect to foreign trade policies. So these series they have been divided into 4 sessions. The first session was held yesterday by CA Saurabh Jain, who spoke on introduction to foreign trade policy, SEIS, and MEIS, now RODTEP. So today's session, which would be led by CA Pankaj Jain on EPCG Scheme versus MOOWR 2019. And the third and fourth session, that would be conducted by CA Vimal Pruthi and by CA Shuchi Agarwal next weekend. So now starting our today's session by CA Pankaj Jain. We would like to welcome you, sir. And so giving a little background about Pankaj sir here. So he is a director with the indirect tax team at EY India. Sir has an experience of over 12 years working with various MNCs in indirect taxes, and he has been working with Big Four consulting firms. So his clients' expertise include telecom, IT, and ITES, Bharti Airtel. Then we have trading such as Verifone India, Invista India, and various FMCG, and also WHO, UNICEF, and UNDP. So we welcome you, sir, and starting with our session today, sir. Over to you. Hello.
Pankaj ji, your voice is not audible.
Yes, sir.
No, sir, your voice is not coming.
No,
No,
sir.
sir.
Just give me 1 minute. Let me check what is the
Sir,
problem.
now it's coming, sir.
Yes,
Now it's
sir.
coming.
Yeah.
Maybe so I'm keeping my camera off. Maybe because
No
of that
issues. No
bandwidth.
issues, sir. No issues.
So thank you, Aditya and Shivangi, for giving such a warm welcome. And good evening, all dear friends, for sparing your time and attending this session. At the outset, I hope that each one of you and your family member is keeping safe and secure in current pandemic situation. Thank you, Professional Times, once again for inviting me on this platform to give my thoughts on a very interesting topic. This is MOOWR versus the EPCG scheme. It's a new topic which is recently been introduced, and in a current time when everyone is hard pressed with the cash flow.
Pankaj ji, just a minute.
Yeah.
I think your screen is not visible.
Okay.
Now it is visible, sir. Now it's fine.
Okay. It's visible now.
Yes, yes.
Yeah.
You can do slideshow, sir. Now.
Yeah.
Perfect, sir.
Yeah. So in a current situation and a time when everybody is hard pressed with the cash flow, one of the basic objective of the government is also to promote investment. It is very important for the government to come up with one of the scheme which can actually help the companies, those who are investing in India, or the companies those who are having their own investment plans or importing the raw materials, and the benefit can be given to them on the basis of some deferment of the duties. And this is what the objective of the EPCG scheme as well earlier, and the advanced authorization scheme also. But now I would be giving you the brief of the EPCG scheme, which we everybody knows. But I will be discussing more on the new scheme which is there, which is MOOWR scheme, and I will also be commenting upon the the reason why this scheme was government was in hurry to introduce a scheme. So let me take you through the controversy of WTO, World Trade Organization. So actually, what has happened in 2018 is that United States of America has raised a complaint against certain export schemes which the India has implemented, like MEIS scheme, EOU scheme, EPCG scheme, mentioning that schemes are the violation of the SCM agreement. Now, what is SCM agreement is, it's a subsidies and countervailing measures agreement which is signed by all the countries globally to provide certain schemes so that they can have a development agreement. So what WTO mentioned, what United States of America or America mentioned in a complaint to WTO is that India is a developed country, or India is a country which is not actually providing a level playing field for their manufacturers. So these schemes are violating the authorities of India. So this is what the entire controversy is. Now, WTO also in October 2019 has recommended the withdrawal of the scheme. They mentioned through their report that India has to done away with these all schemes, which includes MEIS, EPCG, EOU, etc. And once this report is being adopted, am I audible enough?
Yes, yes, sir. In between, your voice is breaking, but now it's fine.
Okay, thank you. So, in October 2019, it means almost a year back, WTO has given in their report that okay, this scheme is not valid and India needs to done away with these schemes, which is actually a problematic situation for most of the manufacturers in India, wherein they are availing the benefit of EPCG scheme and other EOU and MEIS scheme. And so basically, India has filed an appeal against this. If India would not have filed the appeal against this scheme, India is ought to done away with these schemes. Now, India has filed the appeal against the scheme, therefore, they have a breather time wherein they have launched certain other schemes, such as you would have heard about RODEP scheme, which is a replacement of MEIS. Now there is one more new scheme which is there, which is MOWR scheme. This is not only a scheme to replace the EPCG scheme, but also a scheme which is better than the EPCG scheme. So we would be discussing more on this scheme. Now, so this is what all controversy is there with the WTO, which India has. Once the result of an appeal would be out, which we believe.
Sir, your voice is not coming. Hello. Hello. Pankaj sir, your voice is not audible, sir.
Sorry, there's some problem in the internet connection. Am I audible now?
Yes, sir.
Now it's fine, sir.
Yes, sir, it's fine.
Am I audible?
Yes, sir. Yes, sir.
So sorry for the interruption, as there is some problem in the internet because nowadays most of things are on internet. So okay, so this is a very important scheme which has been introduced by Government of India in 2019. In this scheme, if you see the broadly, this scheme is about somebody importing the raw material, somebody importing the capital goods, and which is equivalent to approximately 27 to 30% of the, and they would be required to pay this duty at the time when they would be scrapping those capital goods, or they are selling the raw material used domestic tariff area, then only they would be required to pay the duty. So this is a very important scheme and a very good initiative by the Government of India, wherein this scheme has been introduced, and we have actually seen that the lot of applications which have been filed under this scheme. So this scheme is under the Customs Act, wherein the license has been granted under Section 58 and under Section 65 of the Customs Act, wherein a custom bonding license is been granted. The basic operation mechanism is that the goods are to be imported as in private bonded warehouse. So bill of entry for warehousing goods can be bought in to the factory or into the that bonded warehouse, wherein the in the within the factory the warehousing the operations or a manufacturing operations can be carried upon. If the goods are going to be exported, then there is no requirement for the payment of the duty. So it's basically a cash flow saving, as well as it would be a saving on the BCD as well, without obtaining any extra license such as EPCG license or advanced authorization license. In case the company would be selling the finished goods using the raw material which has been imported, been manufactured by the raw material which has been imported, in that case the company would be paying duty on the imported material in the domestic tariff area. So ultimately the benefit is with respect to the cash flow, or let me take you to the next slide in which I have captured some a brief on the benefits. So if you see this slide, in this, if you see, assuming the total investment of somebody is investing 1,000 crore, and the investment in the plant and machinery which is to be imported, just taking some numbers. So I have taken this number as 60% of the total investment, which is 600 crores. So if you see the quantum of the benefit, the quantum of the benefit is that the duty deferment of the basic custom duty is 45 crores. So suppose if I import a machinery of worth 600 crores from outside India, I would be deferring the value of 45 crores of the duty which I would have paid as a BCD, basic custom duty, on my import till approximately 30 years. So so that is a basic saving which I would be having, and I would be paying this 45 crores after 30 years. So assuming the interest cost of 9% per month, so that means it's a huge, somewhere around 4 times of the value of the goods would be the interest cost saving. So if I, rather than paying it to the authorities, I will deposit this 45 crores in a bank account. So you may assume that 45 crores may become double in 10 years, assuming. So 45 crores of the value of the value money would be, somewhere around 200 crores in 30 years. So this is what the benefit government has given. Now, if somebody says that even if I don't have to pay this duty, so yes, there is also an option wherein government in their rules talks about that in case you clear those goods as a scrap, this planted machinery as a scrap in the in India itself, then only this 45 crore is payable. In case you export the machinery back some to the country outside India, in that case there is no requirement of the payment of this BCD as well. Therefore, there could be a planning option in which somebody can plan to export this scrap back to outside India. Maybe, they might not be getting the full value which they would have got in India. There could be some transportation cost which would be there. Even after that, there could be a comparative analysis which somebody can do, wherein they can see that, okay, 45 crore is the value of the goods which is going to be saved if they export this scrap material after 30 years of being using this plant and machinery back to some country outside India. Then there is an IGST which can be deferred, 18%, assuming the rate of 116 crore is the value of the IGST. Company would not be able to utilize the entire 116 crore of IGST in the first year. So we believe, generally basis our experience, the company approximately it take 2 to 3 years for the plant to get set up, and 2 to 3 years for this IGST to get knocked off with the output liability. Therefore, this 116 crores, the interest cost on 116 crore will also be a benefit which would be there, as well as it would be a benefit in the cash flow issue as well, because the company who is investing, doing an initial investment, would have a better cash flow mechanism, because somebody who is not having in this scheme would be investing 600 crores plus, he would be paying this 45 plus 116, approximately 156 crore or 170 crore extra to the authorities as a duty. which is not been paid by the company who is obtaining this benefit or obtaining this license. The best part of this scheme is there is no export obligation also. So in the scheme, there would be no export obligation whatsoever is there. Am I audible, right?
Yes, yes, sir. Yes, yes. You are audible, sir.
I think I am audible, right?
Yes, sir. Yes, sir. You are audible. Hello. Hello.
Okay. So I am audible, Aditya, right?
Yeah, yeah.
Yeah. So moving on to the next part of the scheme is essentially the key compliances. So if somebody goes for this scheme, there are also some compliances which somebody need to follow. Uh, and this scheme, the compliances of this scheme are like there has to be a warehouse keeper. So there is a requirement to appoint a warehouse keeper who would be maintaining the records of the goods what are being imported and what are being exported, what are the goods which are being bought to the premises without payment of the duty. There has to be a monthly return which is to be filed by the 10th of the following month in a specified format which the government would be providing, and there is already a format. Essentially this format includes that whatever you have imported, what is the value, how much has been exported, how much has been transferred to the domestic tariff area, etc. There has to be a one-time log to be affixed on the goods when there is a movement which would happen. There has to be an undertaking. This is specifically in a standard bond wherein the when the company can provide undertaking to the government. The facilities, equipments, and the personnel. So there is a requirement of affixing the sign stating the premises is a bonded warehouse. There has to be a computerized system of the accounting, etc. So this has generally been facilities which are already there in many of the companies. So that is not a challenge. Company need to maintain the records for 5 years, and there is has to be a proper audit to be conducted by the unit operator. If I want to talk about the scheme with the through the diagram, if you see, if this is a private bonded warehouse, so somebody outside India can transfer the goods to the private bonded warehouse by filing of bill of entry for warehousing. These goods can be bought into the private bonded warehouse, whether they are raw material or they are capital goods. So if somebody importing the raw material or the capital goods, this is importing the raw material. Suppose he would not have any export and all the goods being manufactured in the factory are being sold domestically only, then this is the scheme which is a blessings to him, because say if it takes 3 months of his time to manufacture the goods and sold those goods into the domestic market. So assuming that there is a import of say 100 crores in every quarter, there is an import of 100 crores. So the deferment of the duty on that 100 crore is somewhere around 30%, which means 30 crore deferment is always there. So quarter on quarter there would be deferment of 30 crore. So in an entire year there is a deferment of 30 crore. So there would be a interest cost saving or a working capital saving of 30 crores for that company who is importing say 100 crores quarterly, means 400. Suppose if you have a private bonded warehouse, so there are a lot of apprehension. Can I receive some goods from the DTA also? So there is no restriction of receiving the goods from the DTA. You can very well transfer the goods from the DTA, or you can procure the goods from the DTA. You can always procure the goods from the another custom bonded warehouse also. So any private bonded warehouse obtaining the license can import the goods from outside India, can procure domestically with payment of duty, obviously, because in domestic tariff area, if you are purchasing the goods as a normal purchase, you will not be having any benefit. you can always bring the benefit of the which are there in India. With respect to exports, if you are doing exports, you can do the export outside India by affixing a relevant export document, fixing a one-time log, and without payment of custom duty, obviously. Where you can always transfer to the domestic tariff area also, wherein there is a bill of entry for home consumption is to be filed for the goods which are there in the finished goods, and then the duty has to be paid on those goods. So whenever the goods are being transferred, so it would be automated process which could be adopted by the private bonded warehouse when they would be importing the raw material and then selling the goods, they would be transferring to the other custom bonded warehouse also without payment of duty by filing the bill of entry for for warehousing. So this is the entire process which is there for the MOWR scheme.
Pankaj, sir.
Yeah.
Sir, we have one question. Hello, sir.
Yes, yes, please go ahead with the question.
Yes, sir. So Chaitra has asked one question. How is MOOWR different from in-bond manufacture scheme? Are both schemes same?
So, in bond manufacture scheme is a scheme wherein you need to take a license from in the customs itself, you get a license, and it is more or less similar to that scheme, but that scheme is not very prevalent because there are a lot of, restrictions in that scheme which are not there in the MOWR scheme. There are a lot of compliances which are to be there. Like, for example, you have to pay the bond in the form of the bank guarantee in the another scheme, but in the MOWR scheme there is no such formality, just that you have to pay bond in a B17, form B17.
Thank you, sir. So, so please carry on.
Yeah.
Thank you,
So
sir.
this is about MOWR scheme. Now I would be spending some time in the EPCG scheme. What is the EPCG scheme? Let me take it briefly because most of us are very much aware of this scheme. This is the old scheme which has been there, since ages now, and most of us are very much, importing the goods under this scheme. So this scheme is under Chapter 5 of the Foreign Trade Policy, which is being, facilitate the import of capital goods without payment of the duty. The benefit is that you don't have even to pay the duty. So this is the basic difference. If I would have to see
Excuse me, sir. Sir, you are not audible.
Pankaj sir, you are not audible, sir. Pankaj sir will be rejoining in 2 minutes. I think there's some network issue. हम्म, हाँ कोई नहीं, आप फिर से ज्वाइन कर लो, फिर आ जाएगी, कोई दिक्कत, कोई प्रॉब्लम आए तो बताना। ठीक।
So, in the meantime, in case anyone has any queries, they can put it in the chat box, or they can put it in the comment section of the YouTube channel, Professional Times. Thank you.
Kindly unmute yourself, sir.
Yeah, sorry to there
No issues, sir, no
interruption
issues.
once
Now
again.
it's audible, sir.
Yeah,
You can share your screen.
yeah, just give me a second.
It's visible, sir. You
Yeah,
may proceed.
thank you. So, sorry for the interruption. With respect to this EPCG scheme, so if you see, this is the actual, the illustration in which you see that if the value of the material is 100, so there's a deferment of the duty of 27.75, which is being provided. However, the company has to meet the export criteria of, 6 times within 6 years, extendable to 2 years. So this is all about the EPCG scheme. However, basis the discussion which we had already with respect to the controversy of WTO, there could be a possibility that this scheme can be done away with by the government. Though this scheme is currently applicable, and the any SSE who want to go under this scheme can definitely go ahead and take the license in the scheme and import the capital goods. Now coming on to the comparison of which scheme would be better. So it would not be like that EPCG scheme is always a better scheme or the MOWR would be the better scheme. It depends upon that, whether you know what is your quantum of import, whether you would be importing regularly, and whether there would be an exports which would be there. So there are a lot of different criterias basis which one has to decide whether they need to go to the EPCG scheme or to the MOWR scheme. While as I mentioned that MOWR scheme is always a better scheme, but again there are a lot of criterias basis which one has to take a very conscious call that whether which scheme would be applicable. Just to give you an example, so suppose if somebody has a lot of exports outside India for the goods which they are manufacturing, and they would be able to do met the export obligations without any import of the raw material. So it is always better to go to the EPCG scheme, because in this scheme there would not be any restriction of scrapping the material or importing the material. If they are able to fulfill the export obligation for the capital goods which they have imported, they will definitely not be liable to pay any duty. And in that case, this would be a better scheme for the company who is able to meet the export obligation. While in case the company who is not having that much exports today, he would definitely not be using this EPCG scheme because they don't have any exports or not having that much of exports. So for them, the MOWR scheme would is quite a blessings for them, because they would be getting the same benefit as otherwise was not available to them and was available to somebody who's exporting. So coming back to one by one, basis this chart, physical location. So in EPCG or in MOWR, there is no requirement of specific physical location. So like in SEZ, there is a requirement that it has to be in a designated area. But in this type of schemes, there is no such requirement. With respect to the benefits, there is an upfront benefit of the duty which is being provided under the EPCG scheme, subject to the fulfillment of the conditions, which is that the company has to company has to export the six time of the value of the savings which they have made. However, in MOWR, duty deferment is there on the raw material as well as on the capital goods. So this is a basic difference with respect to the benefit, that in EPCG scheme, the benefit is only on capital goods, and that is also being provided to a company who is manufacturing the finished goods using those capital goods. Suppose if somebody is into trading, so he would not be able to get the benefit of EPCG scheme, while we believe in the MOWR scheme he may get that benefit as well. So duty deferment is there on the import of raw material also in the MOWR scheme, which is not there in the EPCG scheme. And there is no requirement of doing an export in the MOWR scheme. Mm, Basically, you need to pay the duty on the goods when they are when they are exported on their when they are sold to the domestic market. In case those goods are being exported under the MOWR scheme, there is no duty which is to be paid. Under EPC scheme, you have to fulfill the requirement of the six times of the duty payable, which is there in the third point, that export obligation fulfillment is six times of the duty saved amount. While in MOWR, there is no such requirement. Bond and security. So with respect to the bond and security, it is required in EPCG scheme. If bond is required, there is no requirement of the bank guarantee. Like I in one of the question which has been asked, there was earlier warehousing scheme as well. In that scheme also, the government was requiring companies to provide the bank guarantee. In the bank guarantee, there is always a cost involved in it. There is approximately 2% cost which is involved while giving the bank guarantee, and the bank guarantee is generally being given for the 10 times of the duty saved, or at least for the three times of the goods to be imported. So this bank guarantee cost is not there in the MOWR scheme. There is just a bond which is to be executed by the authorities in a specified format. Now, with respect to the availability of the drawback, so this is the important point which is also to be analyzed while going ahead with the MOWR and the EPC scheme. Generally, there is a all India duty drawback rate which are being issued or published by the government after specific time periods for each and every goods. Generally, they range from 0.2 to 1.5% of the value of the goods being exported. This is the drawback under the all India drawback rules. This drawback is allowed in the EPCG scheme. However, in the MOWR scheme, since government is saying that whatever you are importing, you are supposed to import in that scheme. So this drawback is being allowed because government believes that there would be some loading of the BCD which would be there on the imported material. Therefore, this drawback has been allowed, and basis the government calculation, if somebody who is manufacturing a product in which there is a lot of import happens on basis the raw material, this drawback is allowed. This drawback benefit is not available in the MOWR scheme because government feels that there would be no duty which would be payable by the company who is having this MOWR license. It would only be there in case somebody is having the EPCG license, he would be importing the raw material by paying the duty. So this drawback is available only in the EPCG scheme. This is very again a very important point, duration of import. Coming to duration of import, I would say it's not only about the duration of the import. It is like if we have to go for the EPCG scheme, each and every time somebody importing the plant and machinery has to obtain a separate EPCG license, because while obtaining the EPCG license in the documentation, we have to provide the pro forma invoice and the specific details of the plant and machinery to be imported. And that plant and machinery has to be imported within 18 months. So if somebody, generally what we have seen in industry, in after 3 to 5 years, there would be, if it's a big plant, there would be some other machinery which they generally import after every 2 years or 3 years. In that case, every time they import, they have to pay, they have to take this EPCG license, and then they have to fulfill the export obligation. However, there would be a lot of saving with respect to the compliance, though in the MOWR scheme also there would be a monthly compliance which would be there. But in MOWR scheme, the benefit is that once the license has been obtained, it is a valid license in under which we don't have to give any declaration to the authorities before we are importing the goods. Once the license has been obtained, that license is good enough for getting it renewed after every specific time. So we can import the goods under the MOWR scheme without giving any prior information to the authority which is there in the EPCG scheme. So I have seen many companies, those who are having the 8 to 10 EPCG licenses outstanding at any given point of time, wherein they need to check that which are shipping bills, because you have to fulfill the export obligation also, and the export obligation is over and above the export which you have already done in last 3 years. Suppose if the average export being made by the company is approximately 100 crores in a year, and there has to be a six time of the exports to be made in a EPC scheme, which say comes out to be 50 crores. So you have to do that 50 crore exports over and above the 100 crore of exports. So you have to keep those shipping bills knocked off every time when you're doing an export. Mention that EPCG license, and you have to obtain the EODC certificate, which means the export obligation discharge certificate from the authorities. While nothing such requirement or a restriction is there with respect to the MOOWR scheme. So with respect to the applicability of norms, standard input output norms, so that whenever we are importing the raw material, so if we are using that raw material, if we are manufacturing the good which are being sold in domestic market, so how would the government will come to know that what is the raw material being used in the goods which are being sold in a domestic market? So in this case, there are applicability of norms which are there in the MOWR scheme, which are self-certified norms. There is no standard norms which the MOWR scheme is using. Suppose, say for example, I am manufacturing, say I'm manufacturing a Fevicol. So in a adhesive I am manufacturing. So in that adhesive, if I am importing some raw material, so suppose 20% of the raw material is being used in manufacturing 1 kg, means 200 gram of the raw material is being used for manufacturing 1 kg of the adhesives. So in that case, government will ask the duty on that 20% of the value of value of the good, that has to be also paid on the import price. So in that case, I need to provide the self-certified norm standard input output norms that, okay, if I have to manufacture 1 kg, 200 grams of the chemical is being used for manufacturing the 1 kg of adhesives. While no such implications or applicability is there in the EPCG scheme, because in the EPCG scheme, the plain and simple thing is wherein you have saved the duty, government just need to have just need to ensure that the company need to export 6 times of the value of the goods. So this is basically about the EPCG scheme versus the MOWR scheme, the basic differences. Now I open the house for the questions if there are any, in these schemes.
Yes, sir. So there is one question from Manish Bansal.
Yeah.
He's asking, please confirm whether the scheme is available to all importers or is there any condition? I think they're
Uh,
talking about,
which scheme, EPCG or MOWR?
I think MOWR, I guess.
Okay.
It's not
So I will
clear.
answer for both.
Yes, sir, please.
Yeah. So, with respect to restriction, if I talk about, so in case of EPCG scheme, if you see, there is a restriction for somebody to import only capital goods, and the capital goods should be used in manufacturing. So, if I am a trader and I am importing, I am importing a server and a laptop and a computer for trading, using the for doing my trading business, or I am importing the laptops, etc., for providing services, this EPCG license is not applicable. So this EPCG license is only applicable in case I am a manufacturer of the goods and I am using the capital goods for manufacturing. So, and this license is only for the capital goods, not for raw material. So this is about the restriction on the EPCG scheme. With respect to the MOWR scheme, if you see, there is no specific restriction on the MOWR scheme with respect to raw material or with respect to the capital goods. I can import both the raw material and the capital goods under this scheme. The only thing which we need to check is whether I am a manufacturer. Yes, I can import. If I'm a service provider, no, I cannot import. With respect to the traders, there is again a question which we are still analyzing, that whether this scheme would be applicable for the traders also or not, because the schemes talks about manufacture of operation or operations and warehousing rules. So warehousing means it is being used for a trading also. There is no restriction specifically been provided therein. Government talks about that this scheme will not be used for the traders. So this scheme, I believe, would be used for the traders as well. So while there could be an ambiguity on this, but yes, this scheme is definitely for the manufacturers. One more thing, which I wanted to highlight over here is that if you talk about some companies like those who are into exempted goods, so this scheme is most beneficial to the companies those who are into exempted goods. Say for example, one of my client who is into this poultry farming. So while the government has come up with a scheme for the deferment of the duty, so they want the duty, but just that they are helping us to deferment of the duty. However, if in case I am an exempted manufacturer, I'm a manufacturer of exempted goods. So like poultry farming or some else, like if we are into any of the exempted good manufacturing, in this scheme there would be a lot of benefit which would be provided, because if I go back to my example which I have given earlier, if you see, wherein I am saying that this my screen is visible. Yeah. So
Yes, sir.
if you so if you see in my screen, so wherein during this example I told you that this 45 crore is the deferment of the duty, and this 116 crore is a deferment, but this deferment would only be for 3 to 4 years, because otherwise, why I'm saying 3 to 4 years, because otherwise I would have utilized the input tax credit. So I'm taking this the interest cost only for 3 to 4 years. But in case I am an exempted manufacturer, this 45 plus 116, which is somewhere around 161 crores, the entire duty would be considered to be a deferred duty, because in case of exempted manufacturer, the company would not have got the credit of this IGST. So this become a cost for them. So they have to pay this cost only after 30 years when their goods, assuming 30 years or 20 years or 15 years, whatever the life of the machinery is. I
So,
hope, yeah,
can I ask another question?
yeah, please go ahead.
Yes, sir. So there's another question. When licensed warehouse procures domestically, what is the custom duty and IGST impact, and whether BOE for warehouse is required?
So whether BOE for warehousing is required, yes. In case I'm importing the goods in the bonded warehouse, I have to file the BOE for warehousing. And what was the first question? Sorry.
When licensed warehouse procures domestically,
Yeah.
what is the custom duty and IGST impact?
When bonded warehouse procured the goods
Licensed
domestically.
warehouse domestically, yes.
So in case licensed warehouse procured domestically,
Sir, you are not audible. So,
am I audible?
yes, sir. Yes, sir.
Am I audible?
Yes, sir. Now you are, sir. Can you please repeat
Okay.
the answer? Yes, please.
Yeah, Shivani, can you repeat, please?
Yes, when licensed warehouse procures domestically, what is the custom duty and IGST impact that you were talking about?
Yeah. When licensed warehouse procured domestically, so in domestically, suppose if I am a domestic manufacturer providing the goods to somebody else in a domestic market, I would charge say 18% GST. In the same way, if I am selling the goods through a private bonded warehouse, I will charge the same GST at the rate of 18%. Private bonded warehouse would be able to take that credit and utilize that credit while payment of the output liability, or they can claim the refund if they are doing exports. So it would be considered to be the normal transaction.
Okay, sir. Thank you, sir. So moving on to another question.
Yeah.
What is the validity period of license under MOOWR? Even I wanted to know that. How
Yeah.
much validity are we talking about?
So basically, there is a validity of 5 years which has been provided. After that, we can get this license renewed.
Okay, so minimum 5 years we can take.
We can, I would not say minimum, because we can anytime when we want to come out of this license, we can debond our premises.
Okay.
But yes, if we want to continue with this license, we have to take it for after 5 years we have to get it renewed.
Okay. Okay, sir. So moving on to next question, which has been asked by Manish. What will be the implications on import duties of raw material for exempt goods in MOOWR scheme?
Yes, it's a very valid question which I have discussed earlier as well. That in case of exempted goods which are been procured in the MOWR scheme, so the question is whether I am manufacturing the exempted goods, right? If I am a manufacturer of exempted goods.
It is, for raw material of exempt goods. So they're talking about raw material here.
Yeah. For raw material of exempt good, also this scheme is valid because there is no specific criteria being provided that I can go for this scheme only for the when I'm a manufacturer of a taxable goods. So this scheme is very much become valid, for the companies those who are manufacturing the exempted goods, because IGST part of it, which is a cost for the exempted manufacturer, is also getting deferred. So if I am a taxable manufacturer, I can utilize that IGST which I would have paid to the custom authorities while importing the capital goods or a raw material. But in case of an exempted good manufacturer, if that is also getting deferred, it would be a bigger amount getting deferred, and there would be a bigger cost saving also to them.
Okay, sir.
Yeah.
Yeah, so I believe questions. So, sir, if I want to ask,
Yeah, please.
which scheme, just like what would be your, according to you, which scheme would be better, or do we? It is very quite subjective to the conditions, or in your opinion, which scheme is successful, as per se, if we could say that, because it's a versus kind of a thing, right? EPCG.
So if you see with respect to the EPCG scheme, this scheme is currently continued. So while the topic is about versus which scheme, assuming this scheme will continue, I would say we need to analyze. While it is not very subjective that it's depending on a very much different criterias, but if somebody is having a good amount of exports with no import of raw material, I would repeat, somebody is having a good amount of exports with no import of raw material. In that case, EPCG scheme will suit him, because in that case he would be easily be able to fulfill his export requirements. And since there is no import which is happening, so there would be no benefit on import which would be there. Even if we go under the MOWR scheme, then also there is no benefit, because he would be taking this scheme only for machineries. And who, in that case also, if somebody is a regular importer of machinery, then he has to analyze that whether he has to go under MOWR or EPC scheme. Suppose if it's a small companies or a SME sector companies, those who are importing the capital goods once in 10 years or in 5 years, so and they have good quantity of exports wherein they can fulfill the export obligation. In this case, I think EPCG is better. Otherwise, we should go for a MOWR scheme.
Okay.
Because in any case, somebody is into the EPCG scheme has to convert themselves to the MOWR maybe 6 months down the line, in when we believe that this EPCG scheme will done away with due to this WTO litigation which is there.
Okay, sir. Thank you, sir. Sir, there's one more question by Chetra. Whether MOWR is beneficial for EOU, and how is it beneficial?
Yeah. So if you talk about EOU, in EOU, this scheme is used for 100% exporters of the companies also into 100% exports are going under this EOU scheme. So EOU scheme is different and MOWR scheme is different. In EOU scheme also we need to have the bonded premises wherein we take the bonded license from the authorities. We get the benefit while importing the raw material and the capital good, but there is a restriction that we have to do 100% export and there has to be a positive NFE. So MOWR versus the EOU scheme, it is like one has to see what type of business the company is into. While MOWR, if somebody is into 100% export, definitely he should go into EOU, subject to a condition that EOU should also remain after this WTO controversy in case we lose the case, which is a higher probability that India will lose the case against WTO. While MOWR scheme is a new scheme, which is a compatible scheme.
Sir, you are not audible. Sir, you are not audible. Sir, you are not audible.
Am I audible now?
Yes, sir. Yes, sir.
Yeah. So basically, with respect to the MOWR scheme versus the EOU scheme, if you see the EOU scheme, this scheme is entirely for the companies, those who are into export of the goods. 100% export oriented units goes for this EOU licenses. While MOWR scheme is specifically for the companies, those who are into the business of export as well as for domestic market, or those who are the companies, those who are into 100% domestic market. So somebody into the domestic market. So if I'm a manufacturer of soap, say for example, and I manufacture the soap only for the domestic market, and I'm importing a machinery, I will not be able to import under the EOU scheme. So EOU scheme is so, and if I want to bifurcate between EOU and the MOWR scheme, basically it depends upon the business of the company. If I am into 100% exports, definitely I can go into an EOU scheme. I would say in that case, MOWR scheme would be the better option. If somebody has to today go for an EOU versus MOWR, it is always better to go into the MOWR scheme, because all the benefits which are there in EOU are available in MOWR scheme, and you never know when this EOU scheme will done away with by the government owing to the WTO controversy. Yeah.
Thank you, sir. So, sir, this MOWR, it is like the scheme and it is on the updated version, and like maybe in future we all would be shifting to this scheme. This is mostly will be done away with many of the schemes.
Yes. So if you talk about this scheme is basically the scheme which is compatible with the SCM agreement. So there is an agreement signed globally, subsidies and countervailing measurement agreement signed globally. This scheme which is been there, MOWR scheme, is a compatible scheme with that agreement, while the EOU scheme is not. So yes, this scheme will stay with us long, this MOWR scheme, and yes, we can go for this MOWR scheme.
Sooner or later, we will be switching to this because it is more
Yes.
compatible to the global
Yes.
norms or global
Guidelines. Yes,
standards.
it is more compatible with the global guidelines, and owing to the litigation, we believe that this EOU scheme can also get impacted.
Sooner or later, we will
Yeah.
be shifting to MOWR. And so there's one more question by
Yeah.
Sanjeev Mandal. So how SEZ is comparable with MOWR scheme? Can we convert SEZ into MOR scheme? This is what he wants to know.
So basically, his question is, can SEZ convert into MOWR
Yes, sir.
scheme? Yeah.
Yes, sir.
So see, SEZ is a place which is a designated area specified by the authorities, which is considered outside India itself. So somebody, an SEZ scheme, there is, I don't think any challenge would be there in future for the SEZ.
We're not audible, sir. No, sir. No, sir.
Can you hear me now?
Yes, sir. Yes, sir.
Yeah. So in SEZ, SEZ is always in a specific zone. So there is a designated zone where this SEZ units are there. I don't think we would be able to convert that area into the MOWR scheme, because in SEZ it's not about somebody is going to get the license in the SEZ unit. That SEZ area is always having that license with them. We go and get the place in that license in that area. So I don't think we would be able to convert the SEZ designated area into the MOWR.
Okay, thank you, sir. And are there any questions from any one of the attendees or the viewers on YouTube? Let me just check. No, I think. think that okay. So, sir, any last words that you would like to add here?
Yeah. So for me, what we are telling to the clients are, and I think I would urge all of you being professionals to take up this scheme of MOWR to the client, explain this scheme, because with my limited interaction with the companies, wherever I go and explain them about this scheme, they are very excited about it. And because basically, when you talk about saving in this current pandemic situation, talking to the client, when we say that whatever you're importing, there would be a deferment which would be there by the authorities with no restriction and no conditions to that benefit. If there is no restriction and it is easily, if I talk about the timelines within 45 days, generally we get this license. There is no specific condition to this license. So I think we should more and more talk about this scheme with our clients. We should percolate down to the team which we have, so that the industry can get the benefit of this scheme under current situation. And this scheme can get as a successful scheme going forward.
Thank you, sir. And sir, I believe there is one more question here
Yeah, please.
by Sanjeev Mandal. He's asking, can we debond from SEZ and go for MOWR scheme?
I think if so, I will answer it, a different way. While I'll answer this question as well. If the question would have been, can I debond from EOU and go to MOWR? Yes, we can do that, because EOU is not in a designated area. EOU can be anywhere, wherever I want. I could have taken that license. I can debond myself as an EOU. I can go ahead with the MOWR, because in EOU there's a restriction of doing an export. Definitely somebody who is having an export, good exports, now they are not having a good export, or now they are grabbing the local market, definitely debond themselves and go to the MOWR scheme. When we talk about debonding of SEZ, so debonding of SEZ and going to MOWR scheme, in that case, we have to debond, means we have to leave that SEZ area, because in an SEZ area, I don't think we would be able to get the MOWR license. This MOWR license is for the domestic tariff area, wherein we have the factory not in a SEZ unit, because SEZ itself is a designated bonded type of premises, wherein we taking the MOWR license on that license premises would not be possible. So if somebody is in SEZ unit, he can come out of it. He can see the place outside the SEZ unit, means somewhere in a domestic tariff area, debond their goods, transfer them to a DTA unit, or transfer them to a MOWR license scheme.
And sir, we have another question from Vimal sir. Whether under MOWR one can have license and give the place to someone else for manufacture and other operations?
Can you repeat the question?
Whether under MOWR one can have license and give the place to someone else for manufacture and other operations. So can we give a license?
Okay. So basically the question is, can I obtain the MOWR scheme license and I can rent my place to somebody else?
Someone else can manufacture and do their operations over there.
Yeah. So basically, see, it is like toll manufacturing. So it is like about how we structure it. So for example, if I have that license, I have a license in place, I have a machinery which has been imported, I give the entire premises on rent to somebody else who would run the business, run his business. So it would be on me to see and file the compliances, whether the goods which are being imported are being exported, or if they are the raw material which is used in manufacturing of the goods, when they are sold to the domestic market, the duty has been properly paid. So this is generally called as a tolling arrangement, wherein a tolling license is being given to somebody who want to manufacture in my own premises. But it could not be that I take a land and I take the license on it and then I transfer it to somebody else, because in MOWR, when you are going for it, it's an actual user license. You have to import the goods in your name. If somebody else importing the goods on your premises, then there could be a challenge.
The that the license on whose name it is, that person, he only has to conduct the
Yes,
operation.
yes, yes.
No one, you cannot give it to someone else, or they can work on your behalf or
So
something
tolling
like that.
arrangement is possible that somebody, if I have a setup, somebody can work on the entire setup, but I have to have a setup on it.
Yes, it should not be you can just come and do your
Yeah.
work. It has to be properly
Yes.
legalized and formalized.
Yes. Correct.
Okay, thank you, sir. Sir, and there is another question. This is turning out to be quite interesting, and it is
Yeah.
becoming
Please.
too much
Please.
interactive. So the another question is, the can SEZ area be converted into DTA area?
No, we cannot convert a SEZ area to a DT area.
Okay. And so another question is there, whether subcontracting of process is possible in MOWR scheme.
Subcontracting of processes is possible in MOWR scheme.
So you are not audible.
Am I audible?
Yes, sir. Yes, please.
Yeah. So suppose if somebody has the this scheme, uh, just a second. Yeah. So suppose if somebody has the setup in place, he can definitely subcontract the entire process to somebody else. That is possible. As we discussed, that loan licensing arrangement or a tolling arrangement could be there. I don't think any challenge which could be.
Okay, sir. And sir, there is one more question here by Manish Bansal. He's saying that we have to do bonded warehouse. So we have to do bonded warehouse for total factory premises. So how will it be possible one-to-one correlation with raw material and finished goods as a factory going on with raw material available on production line under MOWR scheme?
It's a very, very valid question, I would say. I mean, what is the criteria? How would the authorities know? Suppose if I am a manufacturer and I am manufacturing, how much goods are being used by me during the month? So, as I already discussed earlier, that there would be standard input output norms which I have to certify and give to the government authorities, that if I'm importing this 5 type of raw material and I am manufacturing this 10 type of finished goods, so each and every goods will have these amount of raw material into it. So, and there is a specific format of a return which we need to file every month, which will capture these details. So, if I have to manufacture the goods using the imported goods, the raw material which has been imported, I need to knock it off on the FIFO basis, first in, first out basis, and basis the standard input output norms which has been self certified and given to the authorities, basis which I can calculate the duty. So, giving the same example which I've given earlier, that if I have manufactured 1 kg of Fevicol, I've imported, I've imported, say, one barrel of, say, chemical which has been used in manufacturing Fevicol. If I've made 10 kgs of Fevicol, so I know that, okay, uh, in my standard input output norms, if 200 grams of chemical is been used in manufacturing 1 kg of Fevicol, so if I have manufactured 10 kg, so proportionately, I will assume that this chemical would have been used, and I have to discharge the duty accordingly. And I have to file my return. In that return, the data will be there. Yeah.
All right. So moving on. Okay. So, sir, thank you for the today's session. I hope everyone would benefit from such great insights of yours. from the EPCG scheme and the MOOWR scheme 2019. And I'm sure all our attendees here and the viewers on YouTube and Facebook would benefit from enlightening words of yours. So thank you so much, sir. It was actually quite interactive and it was great to hear you. And so we will continue our FTP series next weekend as well. And for all the latest updates and on the webinars and all the financial and taxation matters, please subscribe our channel Professional Times on YouTube and Facebook. And please do keep sharing our informative videos further. So thank you so much, sir. Thank you so much for your time. It was an honor to have you here. And so signing off for today, happy Navratri, stay safe, stay happy. Thank you so much. Thank you, sir. Thank you, everyone.